I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White, and my guest today is Sean Fenton from Sage Capital. Sean, welcome.
Thank you.
Can we talk a bit about how you do business? Can you explain the difference between the equity extension and the market neutral strategy at Sage?
Yeah, so they're both equity long-short funds, but they serve different investor needs. The market neutral fund, which we call the absolute return fund, has a series of long and short positions across Australian equities, and we're really using our investment skill to identify the best and worst performing stocks there. But the longs and shorts balance, so at the end of the day, there's no market exposure. It's net neutral to the market. Its benchmark's actually cash. So that fund's really looking to just rely on our investment skill to generate returns in a steady manner above the cash rate. Whereas the Equity Plus fund, which is often called an active extension fund, is a long-short fund which retains its equity exposure. So it's got, for example, might have 130% exposure long and 30 short, but it's still got full equity exposure. Its benchmark is the S&P ASX 200 accumulation index. So it will grow with the market over time, and it uses that long-short overlay, the stock selection, to enhance the returns of the market, but it carries the full market exposure and risk. So if, say, interest rates and inflation are going higher and markets are falling, it may still fall and overwhelm the stock selection skill, whereas the absolute return fund might be going up.
Sage has a unique approach to grouping of companies. Can you expand on the premise and the framework of this grouping strategy?
The grouping is quite a common thing to do across the market. Within the S&P ASX index, there's often GICS, General Industry Classification System, which tries to break the market down into similar stocks. So the purpose is really about finding stocks that are similar, that you can make easier comparisons in terms of what's good and what's bad. And by controlling portfolio exposure to those, you can control your risk to some of the broader market risks, like is value doing better than growth, or interest rates going up or down. What we've done is actually improved on that classification with our own Sage group. So we have 8 groups: defensives, domestic and global cyclicals. We have growth stocks, resources, gold, REITs.
Do you find that you're more active in some groups than others, or is it really a question of how the lie of the land changes?
Yeah, certainly some of them are larger than others and have a bit more volatility. So things like resources, growth, yield, there's a larger number of stocks in them and they can move around a little bit more. So there's more opportunity in there compared to, say, REITs, which have pretty low volatility and very similar, or gold, which is a smaller group. So there's certainly areas of the market there that are better or worse.
Putting your advisor hat on, what factors should advisors be most worried about in managing their portfolio for their clients in the next, say, 12 months?
I think looking at a broad allocation, thinking about how much is in risk assets like equities or bonds or credit, compared to things that can perform out of cycle, like alternatives or even cash. And then within equities, I think certainly looking at style concentration within there. A lot of long-only equity managers tend to drive performance by picking a certain style, and growth has been a very powerful one in the last decade or two. And there's probably a bit of drift in portfolios towards growth managers, which that may be challenged if we're in an environment of higher inflation and higher interest rates.
What about your market neutral strategy? Can you explain the unique benefits of this approach?
So the market neutral really fits in what we'd call liquid alternatives in terms of a broader portfolio allocation. So it doesn't carry the same risk as broader asset classes like equities or property or bonds or credit. And these days, a lot of those assets have all been driven by central banks. They've cut rates to zero, expanded their balance sheets. They've been directly buying bonds, and in some countries like Japan, even equities, to the extent where the historic correlations where if the equity market falls, bond prices are generally going up. That's just not the case anymore. They all move around together. So there's more of a need for alternatives that are genuine diversifiers that don't correlate with the broader risk assets in a portfolio. And that's really where our absolute return fund fits in. by really relying on our investment skill to pick long and short positions across the market. But by stripping out market exposure, there's less correlation with other risk assets, and it's more of a genuine source of independent returns. It's not a guarantee it goes up, but it's certainly a good diversifier in our portfolio mix.
Risk management is probably central to everything you do, and with that long-short strategy. Can we lift the bonnet and maybe talk us through a strategy that you've executed in the last 12 months, and so we can understand more how the long-short strategy works?
The last 12 months has been, and even the last 2 years, has been an interesting time across markets, with a lot of things going different directions. So, for instance, when COVID hit in March 2020, markets dropped precipitously, and there were some big changes and switches across the market. So the things we were doing there in our absolute return fund were looking at that overall level of market risk and volatility. So we try and target a given level of volatility and expected return. So when the market becomes very volatile and unstructured like that, we actually shrink our positions down to control our risk. And that's something we did back in March 2020. The other thing...
But now the market came back, though, quickly. Were you prepared for that and positioned for that?
Well, there's the amount of risk you take, and then there's the stocks that you're picking. So the other aspect of risk is understanding how stocks are exposed to changes, and particularly sudden changes. So, for instance, with when COVID hit, obviously travel stocks got hit very hard. Anything with credit risk, there's expectations of a recession, so banks were very weak. So recognising the impact of change quickly and having an investment process and incorporate that, that's very important in controlling risk as well. And as you said, things swung around very quickly as well. So when central banks came and injected liquidity, started buying things up, that started lifting asset prices and giving confidence to the market. And then later on, when vaccines were successfully developed, there's more confidence that lockdowns would end and the world would go back to normal. So being prepared for that in terms of portfolio positioning. So being positively exposed to those most impacted by COVID. So being then long travel as vaccinations came through is very important. Recognising the impact across the investment process of rapid changes is very important. Then there's the aspect of just controlling risk. So we spoke earlier on about the 8 sage groups that we have. So we constantly try and keep very low net exposures, not take a big position in those groups, which means that when the market really swings around like that, collapses and goes back up and things are moving. And even more recently, as central banks have decided they need to fight inflation and tighten policy, you've seen value stocks do a lot better than growth stocks as expectations of rising discount rates have pressured valuations. We don't take big positions across those sectors. We have growth as a separate sector, which we're broadly neutral to. We have yield and cyclicals as separate sectors, so that we don't take a lot of that macro risk in the portfolio. We're really relying on our stock selection to find the best stocks, both long and short, within each of our groups. That means we can control those broad hits from markets and rotations much more effectively, and rely on our broad investment process, a lot of diversification in terms of a range of long and short positions, balanced with each of those 8 sage groups to deliver more consistent risk-controlled returns.
Well, short selling is one of your long suits, if I can put it that way. What sort of themes do you look for when you're contemplating or planning for short selling?
Yeah, our investment process is very symmetric. So the way we approach investing is we've got a very strong focus on the fundamentals. So what drives company earnings, and from all aspects. So is it broad top-down drivers such as industry growth rates and competitive dynamics, what's happening to margins, what sort of barriers to entry are there, government regulation, environmental impacts, all flow through down to the bottom-up micro, understanding management and what their incentive structures are, the operating financial leverage of the business. So really, we're looking for companies on the long side who are able to grow earnings and surprise on the upside, and on the short side, those that may be under pressure more. But we've always got an eye to valuation as well. So it's those fundamentals of investing, earnings and valuation. And our investment process, we really try to rank stocks right across the market and within each of those 8 stage groups. So for us, shorting is really identifying the stocks that have the most earnings risk relative to their valuation and being short there, and offsetting that with longs in companies where the most earnings upside exists relative to valuation. So there's always a broad range of stocks.
Can we talk about any of your short positions at the moment?
Yeah, there's always going to be a broad range of shorts offsetting longs. So, for instance, say within resources, we're long a range of stocks that benefiting from higher energy prices, as well as the transition to say electrification, things like lithium and the like. So we're long both stocks like Santos, a great free cash flow yield on the energy side. It's got opportunities from its merger with Oil Search. We're long Allchem, which is a merger of Orocobre and Galaxy. It's got a broad portfolio of both brines and hard rock for lithium and some great growth projects. We fund that in the short side by shorts on some of the iron ore players such as Fortescue, Rio Tinto, where we see China's steel production really having peaked out and less upside on the commodity prices there. Going into something like the yield sector, we've got longs in Computershare, which I mentioned earlier on. It's got a lot of cash balances it holds for clients that it earns interest on. At the moment, most of that interest is zero, but as central banks lift rates and normalise, they've actually got massive earnings leverage to rising interest rates. On the flip side of that, we see banks who need to, they've got some big fixed mortgage books that are rolling off over the next 18 months. Initially, they get a bit of a lift also, their net interest margin from cash rates moving up, but we see competition really intensifying and a lot of churn as mortgage customers roll off ultra cheap fixed rate mortgages that were helped by cheap RBA funding to something higher, more market based. So we'll have some shorts across banks like CBA and ANZ sitting across there.
A question I thought I'd never have to ask, Sean. World War III, yes, no, or maybe?
It's definitely a maybe, and it's more of a risk than it certainly was, even 3 months ago. So Russia's invasion of the Ukraine, some vague threats of nuclear retaliation have heightened that risk materially. China's obviously got stated ambitions around Taiwan, so that's really polarising the world, and the risk of something going wrong's gone up. I think cool heads do prevail, though. No one wants global nuclear Armageddon, so that's definitely a tail risk. I think we are approaching World War III in an economic sense, though. We're seeing certainly fault lines forming in terms of a Sino-Russian alliance on one side and Western democracies on the other. And that's likely to drive deglobalisation broadly. So we've just had 20 years of globalisation, centralised trade and manufacturing centring around China. Western economies are looking for security of supply. It's been heightened by COVID and interruption, but geopolitical tensions accelerate that as well. And that's going to drive some investment, obviously, back in Western economies, but it will probably be inflationary in the short and medium term as well.
It really does feel like an historic tipping point we're living through this year.
Yeah, definitely.
Sean, thanks for your time today.
Pleasure.